Hello, everybody. Investing Club here. As you all know, the stock market has been taking a beating over the past couple of weeks. And what I hear a lot of people saying is that they're now buying stocks on sale. And everyone is saying stocks are at a discount, buying more stocks. And since they've fallen, that means they're trading at a discount and they're on sale. And in this video, I'm here to convince you that not all stocks are on sale. In fact, a lot of popular stocks are still pretty overvalued. When people say they're buying stocks on sale after this correction, there's a few things wrong with that assumption. First, so the stock market's fallen around 20%. I hear people saying they're buying stocks, like for example, up here we have Microsoft. We have Microsoft falling from $190 to around $150 now. And that's probably around a 30% decrease. And so what I hear people saying are, I'm buying Microsoft at a 30% discount. There's a big problem with saying that. When you say that you're buying Microsoft at a 30% discount, the assumption that you're making is that Microsoft was fairly priced when it was at its peak of $190. I'm making this video to tell you that that assumption is not true. We can look at the numbers here, and even at this level of 150, Microsoft has a PEG ratio of 2, which means that their PE ratio is twice the growth rate. Even though Microsoft has fallen 30%, it's not 30% on sale. The market is at all-time highs, and what that means is so many of these popular companies that everyone has heard of were massively overvalued. And even though a company like Microsoft has fallen 30%, it fell 30% from a point which was overvalued by any valuation metric. And so when it falls now to around 153 and people start buying and saying, I'm buying at a discount, you have to look at the actual fundamentals of the business and be able to justify the price that you're buying at. I'll give you another example. We can take a look at Apple. And so Apple's fallen from around $320 and is now at $275. A lot of people have been saying I'm buying Apple at a discount. The fact is, in my opinion, Apple is still very overvalued and I would not touch Apple at these levels. Even though Apple is a great business, they're simply trading at too high of a multiple to justify purchasing at this price. Apple is currently at a 22 PE ratio, which makes their PEG ratio over a 1.8, which is above their historical valuation. And I previously made a video on Apple and said that even though their sales and revenues and earnings all went down last year, the stock price has increased almost 100%. And when you see events like that, it's just a clear example of irrationality in the markets. Now, as I've made a video on in the past, the S&P 500 index was overvalued. However, now with this crash, it has come into more fair value range. In the previous video I made, I said it's probably a good idea to wait to hold off investing in an index until we see a correction like we have now. So now if I was someone who dollar cost averages into an index fund, I would start putting money in again at this point. We can take a look at the index. It's just a huge drop over the past couple weeks. And so it now falls into the fair value range of between a 15 and 18 PE is, I think what I said was just the historical fair value of the S&P 500 index. I know it's hard. A lot of people don't want to invest at this point because they're scared that the market will go down further. But what you have to realize is that to make money in the stock market, you have to do the opposite of what the majority of people are doing. And this is a great point to buy into an index fund if that's what you invest in. I personally don't. But if I did, I would be very excited to buy at these price levels because even if it goes down more, y'all know that eventually the stock market will go back up and will make new all-time highs. So I just wanted to make this video as a reminder that previous price of a stock or an index or anything shouldn't be a factor in when you choose what to invest in. We can go back to a company like Apple. And so when you see Apple today at $275, just because Apple was at $320 a couple of weeks ago, doesn't mean that it's a good deal now. It could mean that Apple was a horrible deal at $320 and it still isn't that great of a deal at $275. And that's sort of the strategy of investing that I use and that will allow you to make the best returns. You need to find out how much money a business is making and use that to decide how much you are willing to pay for the company. And buying Apple, a company with earnings that may continue shrinking and have faced challenges that they will have to face in the next couple of years at a PE ratio of 22 just does not make a lot of sense to me. So thanks for watching. Check out some of my other videos if you want to learn how to value companies like I do to make sure I'm getting good deals on the stock market. Be sure to like and subscribe, and I will see you on the next video. Bye-bye.